They overreacted, and now they're at a point where they're going to have to overreact again because they waited too long before they started cutting. We're seeing inflation numbers much lower than expected, and the expectation right now is, like you mentioned, they will probably continue to cut over the next 6 to 9 months.
So basically, they're trying to put the toothpaste back in the tube. They screwed up yet again. Um, how have you seen, in terms of just market sentiment, especially within your own industry, is the Bank of Canada starting to lose credibility?
I don't know if it's starting to or it has already.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify.
All right, Jeff Mudrick, thank you so much for taking the time again. Big rate cuts have been seen over the last 2 months. So, what is that, 50 basis points in 2 months?
You got it. It's an exciting time to be a variable rate holder, somebody with a line of credit, whether personal or home equity. People going through bridge financing. A lot of people are saving some money now.
And we also heard a bit of sentiment from the Bank of Canada saying that we should expect more if inflation stays within this 2 to 3% range. Now, a lot of people are saying that this has come too little too late. Tell me about what people in your industry are saying about this and how this is being viewed.
This is something that you and I have talked about on countless number of podcasts. The idea of the Bank of Canada waited so long to react to very, very, very high inflation. And because of that wait, they took 18 months to absolutely flip the economy on its head. Typically, after the Bank of Canada increases or decreases interest rates at one of their eight announcements every year, it usually takes months to, or almost a year, to realize those impacts. So when the Bank of Canada started in March of 2022 to start increasing interest rates, we were not able to see the effects of those until the following year, essentially. But they kept doing it. They increased it by a quarter point, half a point, 75 basis points, a full point, a full 1%. And that really, as I mentioned, just flipped the economy on its head. So they overreacted, and now they're at a point where they're going to have to overreact again because they waited too long before they started cutting. We're seeing inflation numbers much lower than expected, and the expectation right now is, like you mentioned, they will probably continue to cut over the next 6 to 9 months.
So basically, they're trying to put the toothpaste back in the tube. They screwed up yet again. Um, how have you seen, in terms of just market sentiment, especially within your own industry, is the Bank of Canada starting to lose credibility?
I don't know if it's starting to or it has already, but I would say no one knows exactly what the Bank of Canada is going to do. And we've talked about the fact that the Bank of Canada does not know what they're going to do. So I agree that the biggest takeaway from yesterday's announcement was the idea that if everything continues as planned, we're going to see more cuts. I think that statement has really hit home with people. And I've seen a ton of interest in variable rates literally in the past 36 hours because of that statement. Um, they're forecasting economic growth in 2024 to be at 1.2%. So significantly lower than what they initially want. And then 2025, they're projecting it to be at 2.1%, 2026 at 2.4. So, they're staying very conservative in their numbers in these projections. I don't know how consumers feel about these announcements, and I think it is going to bring about a bit of a change in the real estate market.
Yeah, because it seems like if they're overreacting on one side and then to correct for that overreaction, they overcorrect on this side, it seems like the pendulum starts swinging further and faster in each direction. And that kind of creates a problem where people are now thinking, is this system going to break? right? Are they now going to rush to lower rates, putting inflation back in to play here, and then having to correct the other way? And I think there are countries that have seen this in the past, right? Like I think there are countries that have seen um, their markets move kind of, like jackknifing up and down as opposed to steady inclines that we're used to here in North America, and their markets having heavy swings in one direction or another. Do you think we're headed for another big swing? And how are the banks reacting to all of this? Are they kind of taking a more conservative approach and not trusting what the Bank of Canada is saying and planning for a bit more of a bouncy ride here?
Yeah, great question. I think the Bank of Canada waited a long time to react, and they were still one of the first major markets in the world to start to cut interest rates. It hadn't happened like the US is starting to, but Canada made that first jump or even had the conversation about it pretty early. So I think the fact that they did not cut earlier was I'm sure it had some like part to do with the Canadian economy, but I think it also had something to do with, the international community. So that's hopefully that answers a little bit of the first question. But the second part, are banks, like what are banks or lenders doing? How are they pricing their variable rates? What's happening with fixed rates? They're all coming down. And that's good news for consumers and people who are currently in these variable rates. Um, we're seeing a huge spread from about 8 months ago to today. It's about a 1.5% difference on both fixed and variable interest rates.
Wow.
So it's pretty wild. So the first thought as a mortgage broker goes to, hey, who bought in October and November, or who renewed or refinanced in October, November of last year? Because all of those people, they probably locked in a 3-year fixed at over 6%, which at the time, sure, it might have been a decent interest rate. But things change, market change, economies change. So banks actually have not yet, or some have, not all of them, banks, they have not caught up with the now under 5% interest rates that are the common rate right now. So there are opportunities for clients to break the terms of their mortgage, pay the smallest penalty possible, and get in a new mortgage with today's under 5% interest rates. There's going to be a time, whether it might be in a week or it might be in 2 weeks or maybe a month, when the banks start cutting their posted rates, and those penalties that are probably 1 to 1.5% of the balance of their mortgage today will spike to 4 to 5% of the balance of the mortgage. So we're in like a little bit of a sweet spot where, in theory, on paper, it will make sense for clients to break those short-term fixed mortgages that they got in October, November, and land in a much better situation today.
And how are you seeing the underwriters kind of go through that process now? As I mean, it must have been incredibly different and a huge shift in the actual conversations that you're having with underwriters on a daily basis, where before they were so conservative, they had to kind of, look through a microscope at every single document that you're sending them. Have they relaxed a bit?
On the podcast, I will say underwriters are all great at looking through documents all the time. But in terms of risk management and allowing for exceptions, ratio exceptions, allowing for income exceptions, yeah, we're seeing a lot of stuff go through. Whereas months past, we would be required to submit a whole host of supporting documents, potentially asking for co-signers on certain files. And certain lenders, at least, are becoming a little bit more back to their 2021, 2022 days of being a bit more flexible in terms of lending. That being said, I've heard some horror stories where certain lenders are absolutely not. They're being super strict with who they offer the opportunity to refinance or or renew with. There are certain lenders that are really certain lenders are really looking at the loan to value of some of the loans that they've written, and because the housing market has dipped quite a bit, they're stressed. Typically, many houses in Canada have at least 80%, or the banks have 80% equity in the property, 80% loan to value, meaning clients are putting 20% of the down payment. But if that value of that property is decreased over the past year or so, then they're kind of in that, the bank has a lot more risk than the clients should something go wrong with that loan. So we're seeing lenders kind of sweating it out when it comes to asking for refinances. Like, we're back to that appraisal world right now, where appraisals are being asked for on more properties than in the past.
How do appraise? I mean, I'm someone who's super skeptical of the appraisal world. Um, I want to revisit a question that I asked you a long time ago. Well, it wasn't that long ago, but I guess with appraisals and algorithmic price or value determinations through AI and things like that, how far along are we with that? Are banks really relying on AI to come up with valuations for appraisals?
There's three ways that you can get an appraisal done. One is when you submit a file to a lender. We'll call it file to a lender. It goes through their AVM system, the automated value, whatever it's called. It's like their AI system. It's a check mark. Hey, we believe that the property is worth what we say it's worth, or what the client's bought it at. So we have no issue. So that's kind of the AI model. There's no one actually looking at it. The underwriter, it's a click of a button essentially to say, hey, let's go through our internal system. And if it passes the AVM, amazing. Second way of doing it is requesting an actual appraiser to appraise the property. But there are two types of appraisals. One is a desktop appraisal, where an appraiser does not have to go visit the property. All they're doing is looking at online recently sold properties and comparing it that way. The second way is there's actually three ways of doing an appraisal. The second type that an appraiser does is a drive-by appraisal, where they still do not enter the house. They just are literally driving by the property, as is what the name is, and again, running comparables with the neighborhood properties that have recently sold. The third is like a full appraisal, where an appraiser will enter the property, look at full square footage and recently renovations, additions to the property, all that, to then determine a value based on the comparables in the neighborhood. So there's a
Now,
lot of different ways to get your property evaluated.
and this is where I start to get skeptical, because with what did you call it? AVI?
AVMs, yeah.
Yeah, the AVMs, the automated value, was it measurement or whatever?
Automated valuation model.
Yeah, that's where I start to get a little bit worried, because if they're using an AVM model and then calling it a day, and that deal is now done, and there's no one else as a kind of human, I guess, like, safety net to make sure, no checks and balances with people to make sure that that's correct. Are there, these are big banks we're talking about. These are the big five. Are there third party independent auditors who will go and audit the code to make sure that that makes sense, and that shareholders who are investing in these banks understand that the valuations that they're doing are based on a certain criteria that makes sense? Or is it just run it the same way House Sigma does, right? Because House Sigma gives you an estimated valuation of a property, and it's almost always wrong, right?
Yeah.
Like, what are we talking about here? Because this is our entire economy banking on that.
I would say this. So usually, in order to have that AVM pass, it has to be, even though like the minimum lending requirements for, won't dive into the specifics too much, but the minimum loan to value ratio is 80/20. So someone has to put at least 20% as a down payment. In order to pass that AVM, clients it would have to appraise at 75% loan to value. So there's a little bit of check and balance there. But when lenders are turning off the taps and wanting to really get their books more in line, they have the flexibility to not have these AVMs like sign off properly. And they can instead, maybe they don't want it to be 75% anymore, loan to value. They can drop it to 70 or 65. And if it doesn't pass at that, then sure, they're going to require a full appraisal to be done. Do they do that? And how often do they do that? I have no idea. But in theory, it's a pretty, should be able to log into a main system and just change that number. But again, like as we talked about, every bank, every lender has different risk tolerance throughout the year. And that's why certain lenders for 3 months have amazing rate specials because they want to buy up all these mortgages. And then for the 3 months following, they're terrible because they got all the business and then they can run with that. So there's all these different types of ways to mitigate risk, but do all banks do it at the same time? Absolutely not.
Talk to me a bit about exceptions, because I know that this is a very, very big selling point for a lot of people in your industry in particular, where they'll say, hey, we can work with you. There are these criteria that typically a bank will want to see, but don't worry, we can massage it, right? And I think that scares people about the system in its entirety, because if there are exceptions that are kind of pushing the envelope and they're happening so often, that how stable is it really, right? And now that interest rates are starting to come down, I guess it's a little bit less of a concern, but it doesn't, it doesn't change the fact that should there be some kind of check and balance on those as well, on those exceptions.
You got it. Like for most big banks on paper, if you're reading the mortgage lending guidelines of Canada, big banks will allow clients to borrow or their monthly payments, their monthly payments to be a maximum of 44, just under 44% of their gross before tax income. That's pretty standard with every lender in Canada.
Doesn't that seem high to you?
It's been that way for a long, long time. Does it seem high? Absolutely. So that 44% is mortgage payment, property taxes, heat, and any debt the client has can be a maximum of 44%.
Wait, so hold on. Total debt servicing ratio, then, I guess is what you're referring to. That includes things like car payments and stuff like that.
Everything could be a maximum of 44%. The
I see.
mortgage payment itself, mortgage payment, property taxes, and heat and condo fees, that could be a maximum of 39% of a total family's income before taxes are taken off. That's across every lender in Canada. Every insurer accepts that deal as well if a client's putting less than 20% down. The exception happens when clients are buying in a populated area like the GTA, and maybe their ratios are 49.9% of their total household income. And that will get approved 9 times out of 10 when lenders are wanting to get mortgages. Not every lender does. Some lenders do mitigate that risk, that additional 5+%. They do mitigate it with things like, hey, you have to show us that if you're buying a property, you have to show us that you're not putting every penny you have of savings into the down payment and you have a bit of a reserve fund. Things like that, some lenders do. Some lenders could care less. You have to have good credit score. You have to show some stability in your career, your industry. But in terms of risk, yeah, like if I'm spending 50% of my household income on my mortgage and debt, that's not what I want to do with my money. And that's pre-tax income as well. So yes, it is scary when clients choose to go that high.
Given, I guess, the climate of the market right now, with there being so much inventory and things are kind of sitting and people are having a really rough time, what are some of the ways that you're seeing people make it happen and make it work for themselves? One of the things that I've seen a lot right now is just, upsizers kind of coming out of the woodwork now that prices have dropped. The relative price value, when we see percentage drops kind of be almost equal across the board, is substantial when you put it in a dollar value. So I've seen a lot of upsizers come out of the woodwork. However, those upsizers typically are pushing the envelope. So how are you seeing people make it work right now?
Yeah, there's a lot of conversation, or like again, we've talked about it, but I live in budgets and numbers, so I kind of try to rationalize it. I try to take emotion out of it and just look at what the numbers are telling me. There are a ton of upsizers. You got it. Like they're definitely coming out of the woodshed to find opportunities. And as much as it's maybe the not ego, it's tough to take a hit on your current property. But the idea around taking a bit of a hit, selling it for less than what it was worth a year ago, to then buy something at a price that was less than what that property was worth a year ago, it kind of hopefully evens out, or hopefully clients are coming out ahead. Are you seeing the same thing when it comes to clients trying to upsize and what their mindset is?
Yeah, totally. I think that the main issue here that we're seeing in this market is people are really starting to understand and appreciate the relevance of first-time buyers in our market. And that without first-time buyers, you have a domino effect of everything else freezing up. You have people in Canada who, I mean, very few are looking to downsize. There are very few, I mean, there are empty nesters from time to time who want to downsize, but for the most part, nobody ever wants to downgrade their living situation. Almost everybody always wants to upgrade their living situation and make it either more comfortable, more spacious, and easier for them. And so when you have an entire country trying to do that, or you have an entire city trying to do that, you really depend on the people at the bottom to make sure that they're allowing for everybody to move up, because you've got the people at the bottom who start eating up the lowest price bracket of inventory, which allows those people to then use their equity to purchase above them, and so on and so forth, all the way up. And so I think that that's kind of the problem that we're seeing in first-time buyers right now, are basically non-existent.
And I think, correct me if I'm wrong, when you're talking about those lower priced properties, I believe you're probably talking about condos in Toronto,
Oh
because
yeah,
we could do a
1
whole
million
episode.
percent.
We
Oh
could do a
yeah.
whole episode on what the heck's going on there. Um, but you got it. There's not many people downsizing to a condo in Toronto. Usually, for the past, you tell me how many years, it's the complete opposite. You get started with a condo, it typically has appreciated quite a bit. You use that, you sell it, you use the equity plus the amount you've already paid down on your mortgage, to then use it towards a down payment on another house. Everyone says you don't buy your dream property right away. It's no one's first home, or rarely anybody's first home. So you need those first time home buyers to allow this to happen. And I can't tell you that I should make a list of how many first time home buyers I was referred to, had a conversation with, ran the numbers, and had to say, like, hey, you've been renting for 3 or 4 years or 5 years, you're paying $17.80 a month. If I'm you and you don't need to move, I am staying put. Um, you're going to double or triple that monthly payment for a condo in Toronto right now that is like a two bed, two bath. And it is like, from a numbers game, it's hard to imagine a property just appreciating through the roof enough to make up for that, 3 grand a month spread on what you're currently paying. So there's been a lot of these types of conversations, and the other side to it is the people who started renting 2 years ago, who are paying $3,300 a month in rent, and now the interest rates are coming down, where you can get a nice condo for 500 grand or 600 grand, where the monthly payments are going to be pretty much the same. So different situations for everyone, but yeah, it's a pretty wild time in this lovely condo market in Toronto these days.
Yeah, how are you able to work those deals? Because I'm sure lenders are not excited about the idea of a condo. Number one, the condo market is terrible and dropping very quickly. New sales of condos are basically non-existent, and I'm not sure that any lender would want to fund that kind of deal. And maintenance fees are basically a black hole for money, right? It just gets sucked in and then goes beyond the event horizon, and you never see that money again. And that's what maintenance fees are. So, and they go up every year, right? So what are lenders looking at from that perspective, and how are they viewing and approaching condos?
I haven't seen a huge change, but that being said, we've probably seen like 5 or 10 condo purchases this year. Like it's been a very, very slow market for condos. It's like on our side of the business. Um, More appraisals, but besides that, I think lenders have faith in the GTA and in the market, and eventually, long term, they'll be, I think we can all agree that it's likely over the next however many years, this dip is not going to continue. It's an ebb and flow, just like our lovely friends at the Bank of Canada are going to continuously play with the market. But yeah, like I haven't seen a huge change with how lenders are approaching certain types of properties these days. If it's outside a populated area, there's a lot more due diligence that needs to be done. But in the GTA, we're still fine.
Well, they better have confidence in the GTA, because it's literally their job. It's the only thing that they do is
Yeah.
lend on the GTA. So if they don't have confidence in the GTA, then nobody should have confidence in the GTA real estate market. So that's definitely true. And as for our friends at the Bank of Canada who have been playing fast and loose with all of their models and concepts of economics that clearly they can't have understood and understand, and I don't even fault them for that. They can't possibly predict these things. It's the systems are too massive for us to be able to compute as humans. Too multifaceted. We simply just don't have the capability. Maybe one day when we have like artificial general intelligence or something like that with unlimited computing through quantum computing, like something crazy like that, can maybe then give us better direction. But playing fast and loose with the interest rates has only caused people an enormous amount of pain. And
I think honestly, if the Bank of Canada kept interest rates at whatever, let's say 4%, let the economy stabilize, which it probably would if it cut it 2 more times and just hold steady. I think most people, if we're looking at a 4 to 4.5% on interest rates, um, I think there would be more money spent, and I don't think people would overspend. When it was 1 or 2%, I got a client mortgage at 0.99%. Free money at that point. Why would you not want access to that home equity line of credit and spend as much as you can when you had access to, yeah, it was like the Bank of Canada just handing out money. It's not the case anymore. It's pulled way back. Nobody wants to spend money. The prices everywhere are making us spend. You can't go to a diner anymore without, well, if a family of four, you're walking out spending $100 every time, any meal. So I think if the Bank of Canada says they're focused on restoring price stability, that was also in that announcement. So that should be the goal, price stability. Hopefully, they're not going to overreact to get there.
well, I think also it has a lot to do with the fact that a lot of people don't yet quite understand, and I don't fault them for this. Everyone has, their specialty in our diverse economy, and that's great. And that's what we need. We need specialization. However, most people don't take the time to understand what the difference is between the overnight rate and what real interest rates are. And when you actually look at real interest rates, which is the overnight rate minus the inflation rate, you get the real interest rate. We were at negative real interest rates throughout COVID, where money was not just free, but it was burning a hole in your pocket. You had to get rid of it. And this caused a lot of problems, because when you do that and you take real interest rates into negatives, you're essentially borrowing from the future, if that makes sense. You're borrowing all of that purchasing power from the future, and then when that future hits, the piper's got to get paid, and that's when interest rates start to have to go up, or else inflation runs amok, and then you end up with the actual civilization itself breaking down because you're encouraging so much nefarious activity because people just cannot retain purchasing power. It's a very dangerous thing. And so I understand why there's such an emphasis on the Bank of Canada restoring price stability. However, at the end of the day, they're just humans and their models are ineffective, to put it, really nicely. And there's no way that they could have possibly done anything, in any other way that would have resulted in less political backlash. So it's kind of just a mess, but I think if they do lower it modestly, the way that you're kind of putting it, and keeping people in check and forcing people to be financially responsible, in that sense, I do have some confidence that we're going to see a market that is stable and not running off the rails in one direction or another, which is really what we're looking for, is what Canadians want, right? It's stability.
Balance, a balanced market. Just and again, to put our faith in the Bank of Canada to get us there is unrealistic, in my opinion. It's not going to be them. It's going to be, in part, it's going to be them, but like you mentioned, it is going to be a lot of consumers that are, even though money is getting cheaper on a monthly basis over the past all summer long, um, fighting that urge to go out and spend it. I think what you just spoke about is so true, and it's something, if your avid listeners go back to a podcast that we filmed probably 3 years ago now, when you said if you have cash for a down payment, it is losing you money by sitting in a checkings account. I remember you saying something along those lines, and it was because inflation was through the roof and you could not spend money fast enough. Anyways, you could not spend money fast enough. So, yeah, it's just that brought me back to those early COVID days.
Yeah, well, inflation and the inflation numbers themselves are highly politicized as well, right?
Oh,
This,
yeah.
they pick and choose the numbers and how they measure it, and it's all measured by a basket of goods. And but then if something's too volatile, they take it out of the basket of goods because, why would you ever want something volatile in there when you're trying to measure the volatility of pricing, right? Like it's just such backwards thinking. But this is exactly what happens.
And we know that an election's coming up over the next year or so, and that's also going to have a huge impact on what is going to happen with the Bank of Canada and the economy. And so I understand why the Bank of Canada makes these goals and predictions and forecasts, but really and there's an election in the States this year, it's going to have an impact. So there's 1,001 factors that, besides inflation, that are going to come into play before these rate increases or decreases are done.
Are you at all concerned about things like bank failures and things like that? How are we looking now? Because I know that we were talking about things like that before, where the bank's balance sheets were just not looking very good. Loan to value ratios were all over the place and out of whack. And there were discussions about that. TD has seen a lot of hot water over the last few years for a few different reasons, between the money laundering and the just being caught with their pants down with all kinds of bad loans that they were giving out. Are we starting to see a bit more faith restored in our banking system?
I would say so. I would say, it's, and not only singling, like CIBC. If you Google CIBC right now, there's lawsuits all over the place. So it's a I would say yes, there is more faith, but really what we're seeing right now, at least on the mortgage side of things, is some lenders are just being and it worries me. Some lenders are being so aggressive with interest rate, like blowing out competition certain weeks at a time by about 20 basis points when they don't need to, throwing cash back and this and like so much money into buying mortgages. And we're not really too sure why that is right now. It's great, from like being able to offer a great interest rate, that helps, sure. But why certain banks are doing it when the majority aren't is something that is of some concern to me. Um,
Well,
what
isn't
is
it because, I mean, isn't it because, simply put, they have shareholders that they have to make money for, and their job and how they make money is by selling mortgages. And when no one's buying anything, they're not selling any mortgages. And so they have to be competitive and make money for their shareholders, or else they're just, well, they're gonna lose on the valuation of the company.
I'm with you, but what we're seeing is just it's such a huge disparity between like one big bank and the other four. Like, why is that happening? And the other four are fine to offer their whatever it is, like let's say 4.75, and another lender's coming out at 4.49. Um, never,
Whoa.
never advertised rates, but just what we're receiving back on these rate exception requests, like what I'm always curious, like what's going on. And the other thing too is that there are some stats that have
Hold
people
on, hold on. Sorry, tell me more about that. That was really interesting what you just said, because this is not advertised. People can't see this out there in the public eye, but this is something that's happening because all mortgage negotiations happen privately. These are private mortgages, right? They're all this is a private business deal. This is not a public thing. So
You got it.
when
So let me walk into it. Let me walk viewers through kind of how the process works. All lenders, whether it's Scotia, TD, RBC, like whoever that is, when you look online, they're all going to have relatively the same interest rate. These are the rates that you will get offered upon renewal. If you're within 4 months of your renewal period, you'll get a letter in the mail that says, "Hey, here are our interest rates," and they're going to be in line-ish with what you. If you go on their website, you're going to see those rates as well. What happens is there are rate teams at different lenders that will offer rate exceptions. We're talking about exceptions again, based on usually, like they say, it's based on your credit, your income, your down payment, all that. Really, what it comes down to is based on mortgage size is going to be one of the biggest factors, and amortization period, the length of the amortization. Based on that, we will submit clients' files to the lender's rate team, and they'll come back with their best available rate on that day. It's not advertised. It's technically considered an exception, and it's not guaranteed. But once we get that rate back, it's always, at least 30 basis points lower than what clients will see online. And as a broker, it does not cost me one penny to get that rate exception done. Doesn't like it's not like, oh, I don't want to do it because I'm going to lose money. With certain banks, the way their pay structure works is if they get that base rate, that mortgage rep will get like full commission on the deal. And the lower the interest rate, the less commission a bank rep will get. So, anyways, I don't need to dive into the broker versus banker conversation right now, but that hopefully gives some insight into how these rate exceptions work and how clients will never really see these exceptions until there's a live deal on the table.
And so why do you think, given your experience, why do you think there's such a huge disparity when different banks are fighting for a file?
Yeah, like disparity between different banks.
Yeah, because that seems, I understand being competitive, but that seems like a freaking huge
Huge, man. And
disparity.
it was so interesting. Every broker, every party or dinner or barbecue we went to, we were talking about this. It was wild, where they were just getting certain lenders are just blowing others out of the water. So the reasoning for that, it's a great question, because when everyone says banks make a ton of money on mortgages, and they absolutely do, but there's a lot of upfront cost to buying that mortgage. Cost one is using a broker, or brokers and bank reps, they each get paid commission based on having that mortgage funded. So the cost of the bank rep or the broker, the cost of the cash back, the instant cash back that lenders have been giving recently, usually like $4,000, up to $4,000, the cost of the underwriters, the cost of the rate team, the cost of the business development management. Like there's a ton of upfront costs to underwriting and to getting a mortgage approved. So what lenders say is they don't actually make a ton of money that first year or 18 months of having having their hands on that mortgage. It's after that, it's at renewal when 52% of clients do not shop their renewal and they'll sign a piece of paper. And that renewal, those offers are essentially free. There's no cost involved. There's no underwriting. There's no paying a mortgage specialist to do that. So, the theory is that they're buying this business for 3 years down the road when they're just going to offer this shitty renewal rates to their clients, and 52% of them are gonna sign that offer.
Wow. So I guess just message to everybody who's listening who is a consumer. Anytime your renewal is coming up, shop it. Make sure that you're forcing your bank to compete for your business upon renewal. Is that the message here?
You got it, man. Like sometimes too, I've done this 3 times in July where it was the best case scenario for the client to remain at their current lender. We ran through a bunch of scenarios. It made the most sense, even though I can get a better interest rate for these specific situations, just made more sense to stay. So because the client, because the client shopped, we had approvals with other lenders, and I said, "Hey, client, I'm here. Just wanted to let you know we have an approval with a better interest rate. If I were you right now, because it makes sense for you to stay with the current lender, if it's me telling my sister or telling Adam, I would advise them to take this, and the current lender should match that rate," which they did. So even though I did not get any business out of it, it made sense to still go get that second opinion. And clients walked away saving, one client, it's a big mortgage, saving like $312 a month for the next 3 years by picking up the phone and calling somebody they trusted. It was a win-win.
Wow. Well, that's an amazing message to end off on because a lot of people are facing sticker shock on renewal right now. So if you need help with that, or you need help, kind of shopping it around so you can help negotiate your renewal, give Jeff a call. Thank you so much for taking the time. Where can people find you?
You can go to chatwithjeff.ca. It's the easiest way to get a hold of me. And yeah, anytime Adam puts out a podcast, I'm always happy to be a guest on here. So keep your eyes out.
Thank you so much, sir. Thank you, everybody, for tuning in again, and we'll see you next time.